Hello business owners and entrepreneurs, my name's Aaron March, and in this video we're going to learn how to value your business by using the multiple of normalized earnings method. So if you want to be like Shaq and not like Dawson, you should always know the value of your business. The multiple of normalized earnings formula is exactly what it sounds like. It's where we calculate the value of the business by applying a market rate multiple to the maintainable earnings of the business. The formula is pretty simple. It's simply business value equals normalized earnings times a multiple. Now to demonstrate, I'm going to run you through a quick example, and the first step is to normalize the earnings. And to do that, you start with profit. And in our example, we're going to start with a profit of $5 million. The next step is to normalize the earnings. When we normalize the earnings, we want to uncover the business's true maintainable profits, adjusted to reflect what a typical buyer could expect to earn moving forward. And in doing so, we adjust for any transactions that are one-off, not reoccurring, private, or not related to the business. We've reviewed their accounts and we can see that they've overpaid rent to a related party, so we'll make an adjustment. They've also incurred some legal fees, which are once off and not going to happen next year, so we can again make an adjustment. And finally, we've noticed that the owners are paying themselves only $200,000 as a salary and wage. However, the market rate for that job is $300,000, so we'll make an adjustment. And now you can see that our normalized earnings has increased to 5.6 million. The next step is to apply a multiple. In this example, we're going to start with 3, which is a common multiple for your average business. The business value equals 5.6 times 3, which is 16.8. So we started with a profit, made our adjustments, applied the multiple, and we've now determined this business is worth 16.8 million. Now you can tell by the formula that the multiple that you use is going to have a huge impact on the value of your business. Average businesses sell at a multiple of 3. Worst businesses, multiples of 2 and 1. However, the really great businesses can sell at multiples, to 4, 5, 6, 10 plus. You can see here when we use 3, we achieved a business value of 16.8 million. However, when we use 4 and 5, that increases to 22.4 million. And even up to 28. Hopefully this formula provides some clarity for business owners that you should be focusing on, firstly, increasing your profit, and then the strategies that are going to improve your multiple from a 3 to a 4 to a 5. If you're interested in learning about multiples, contact me in the link below and I'll send you our cheat sheet, which has got the top 50 ways to improve the multiple of your business.
When I was learning about multiples, it was explained to me that the multiple that applies to your business is based on the business's risk and how certain future cash flows are. Now that never really resonated with me too much. So I like to flip it the other way. And so the multiple is based on how good is your business. And to determine that, put a business buyer's hat on and look at your business and say, how good is this? The better your business is, the better the multiple. 3 factors that will impact your multiple are reliance on the owners, customer concentration, and the strength of your management team. Now, if you think of this as being a business buyer, it all makes sense. You don't want to buy a business where the whole thing relies on the owner, and if they leave, the business falls apart. You also don't want to buy a business where, say, 50% of the revenue is tied up with one customer. What happens if you lose that customer? And also, you want to buy a business that's got a really great management team in place that can run the business once the owner's left.
Typically, when a buyer is looking at your business, someone from their team is going to have a look at it in terms of return on investment. And here we can see the multiple has an inverse relationship to the return. So if the higher the multiple, the lower the return for the buyer. So for example, you can see here, a 10 multiple gives you a 10% return. 9 gives you 11%, 8 gives you 13%, 12, 14%, and it goes on down the list. So if you think about investment, a 10 times multiple and 10% return, well, you can probably just get that through an indexed fund. So that's why it will be rare for somebody to pay a 10 multiple, because there's much less risk involved in just buying an index fund compared to buying a business. And if we have a look at the bottom end of the scale, you see here that a 1 times multiple will give you 100% return. A 2 times multiple gives the buyer a 50% return. A 3 times multiple gives you a 33% return. 4 gives you 25, and 5, 20%. In this area, between 1 and 5 is where you see most of the transactions happen, because that gives you a suitable return for the risk of running the business. Most average businesses transact for a 3% multiple, which implies a 33% return for the buyer. If you're a really good business, you can transact at 4 and 5 times multiples, because the buyer is happy to accept a 20 and 25% return. Typically, if I'm buying clients, for the risk involved in running a business, you want at least a 25% return. So often you'll see a cutoff mark at about there. However, if it's a really great opportunity, you can sometimes squeeze up to 5 and accept 20%. Businesses do transact at this higher range of multiples. And the reasons why is because the buyer thinks they can grow the business, or they can reduce costs, achieve synergies, or the purchaser might be focused on buying an asset, which might be the goodwill of the company, its technical know-how, a client list, or some other asset, and the purchase price isn't linked to the cash generated by the business. This explains why Mark Zuckerberg paid $1 billion for Instagram when it had no revenue and only 13 employees. If you're interested in learning about multiples, contact me in the link below and I'll send you our cheat sheet, which has got the top 50 ways to improve the multiple of your business. When you're buying or selling a business based on normalized earnings, it's a great question to ask: what do you actually get as part of the transaction? And the answer is you get everything that is necessary to generate the normalized earnings of the business. And so that's going to include goodwill, which includes things like relationships, brands, websites, the reputation and the system. It's going to include all the operating assets to run the business, which is going to include plant, equipment, and inventory. You're going to need the existing team, access to the customers and suppliers. And finally, you're going to include the regular amount of working capital. Now, working capital isn't always an interesting one, and it's sometimes used as a bargaining chip to get the deal done. As a business owner, it's important you understand what your regular working capital requirements are, and that if you sell your business, generally the working capital is included in the sale. The multiple of normalized earnings approach is one of many valuation techniques, and it's best suited to established, profitable businesses where the future earnings of the business are the key driver of value. Common examples include professional services, accounting, legal and consulting, hospitality, multi-site businesses, manufacturing and distribution, trade and construction, online and digital, and healthcare. The multiple of maintainable earnings valuation approach is best suited to established businesses that have stable revenue and profits, repeatable operations and systems, and predictable future earnings. It's less suited to startups or early stage businesses, or businesses that are experiencing rapid growth or rapid declines, where the future profits are volatile and unpredictable. This method is simple, widely used because it's easy to understand for both the buyer and the seller. It's common in private business sales, mergers and acquisitions, or even when raising capital, because it focuses on cash flow and profitability, which is really what matters. Okay, and so we're wrapping up. We've learned a great formula of how to value your business. It's your profit times by a multiple. And a multiple is a function of how risky your business, or as I say it, it's a function of how good is your business. If you want to learn more about multiples, contact me via the details in the description below, and I'll send you our PDF called the Magic of Multiples cheat sheet, which contains the top 50 ways that you can improve the multiple of your business. Also, if you just want to have a chat, reach out via the details below. Thanks for watching.